Now, unlike your textbook, I like to begin the discussion of what we're going to cover in this class with the business or economic entity assumption. And what you'll note in this first series of videos is that supplemental handout that I described in a video and showed you, like, some of the slides from that. A lot of those pieces, principles and assumptions and constraints and whatnot, are all going to come into play. A lot of them will happen in this first stretch of the class here. So I've decided over the years that the best beginning point was the business or economic entity assumption. Now again, all we're doing here, it's one of those, it's such a fundamental concept, it's sometimes almost a little bit difficult to describe, like, what are we talking about here? All we're saying here with this assumption is that each business is an autonomous entity separate from what? From the owners of the business, employees, and of course, obviously, other businesses. In other words, we're just simply saying that we're accounting for just this one single unit and nothing else. We're not including any other things, not including the finances of what's going on with the owners or employees or other businesses. So it's just whatever is specific to this company. So again, it's so fundamental that it feels a little bit like obvious, but it still bears inclusion. Now, the idea here that the way I've decided to tackle it over the years is to talk about, like, what are the risks associated with this assumption? In other words, what are things businesses could do to try and change how the business actually looks? And I realize there's really two prongs here. One of them is a little bit harder to get away with necessarily if we're talking about somebody doing something illegal, right? Something improper. So in other words, if we want to inflate the perceived value by, for example, saying that you're doing more business than you actually were doing. In other words, you have all these contracts for to deliver goods, for example, and you actually they don't actually exist. That can be a little bit more difficult to hide because somebody has to come in the form of an auditor. And we mean auditor in the accounting sense here, in financial accounting. We mean it's usually a partnership that comes in, a firm that comes in and examines your record keeping to see if you're adhering to generally accepted accounting principles and all the principles and all the foundations that have been promulgated by the Financial Accounting Standards Board, which is abbreviated FASB. So that's what I mean by auditor. They will probably find something like that immediately, right? Because fake contracts for business you didn't actually do, they'll figure that out quickly. So what you could do instead to try and change the perception of the business here is try to remove things, right? Instead of adding something, subtract something. So the thing that I focus on is possibly, let's say, off-booking debts, again, the amounts owed, possibly trying to hide losses through that same process here. Now, I focus on, as an example of what I'm getting to here, I focus on defunct energy giant Enron. Again, they've been gone since 2001 now. It's been quite a while. It's almost 20 years, almost 2 decades since they went under. Now, again, this is a very complicated case that we're talking about here, so I'm just going to focus on a piece of what they were doing. And they did this many, many times. This is just one example what they did. But they would take a portion of what was properly part of Enron's business entity, and instead of including it, they spun it off. So this idea of spinning something off is simply meaning they artificially separated it and created a new entity. It was a whole series of entities like this. I'm just going to focus on just one of them, which was named White Wing. Now, the purpose of this extra entity that was really part of Enron was to buy property. So again, it bought property. I put that in quotes because it really wasn't buying anything, as you'll see in a moment. And this was purchased with a bank loan secured by shares of Enron stock. And again, all a share of stock means is it represents that piece of ownership of the company. So in other words, if there's 1 million shares in a company and you own 1 share, you own 1/1,000,000th of it. In this case, the people who were securing the loan were chief officers, so they had a lot of these shares on hand. So they were able to go to the bank and say, hey, we have a ton of these shares to serve as security on the loan. So the whole purpose of this was to make it seem as though Enron had made money on the sale of property. Now I'm going to go to a new slide here and upload. All right, so what we're going to do is try to diagram what happened here. So we had Enron. Right, so there's Enron's logo. And then we also had the other entity, White. All Okay, so there we are with Enron and White Wing. And again, what happened between them was this. Again, Enron said, we're going to give you some of our property. Right, so PROP. And White Wing said, okay, here's money in exchange for that. And again, where do they get that money again? They got it from a bank. So poof, there's the bank. All right, so again, that money went from the bank to White Wing. And again, as I described in the text, White Wing said, hey, they didn't give this, but they said, hey, we have shares of Enron stock. I said shares of E there as security for that, because that's the way banks work. They want something to make sure if we don't get paid back the loan, what's our fallback position? Oh, we have these shares in Enron. Now again, just to recap what was happening here is Enron sold property to White Wing in exchange for money that was secured from a bank with shares in Enron. Now the whole thing sounds kind of phony because it's like, well, wait a minute. If that represents ownership in Enron, how can that be used as security for the loan, which was secured to do what? Buy property from Enron. It almost sounds like Enron buying property from itself, and that's not far off. Because the reality here, again, if you take away the illegality, is that, I mean, this is really, oops, didn't mean to draw over that. All right, let's try that again. There we go. That really, I mean, this is the entity here. Like whatever's happening here is completely phony. It's a non-starter. So really, if you simplify this down to what it really was, taking out all the pieces that are fabricated in order to make Enron look better than it was, make it look more profitable than it was. I mean, this is really the reality, is this was just a loan. I'll try that again. Using a mouse to draw on this is less than easy. All right, so still trying to figure out the dexterity here. So this is really all it was. It was just a loan to what was really Enron from a bank. I mean, that's all it was. So all this exchange of property for in exchange for money was really just phony. I mean, that was the purpose of it, though. The purpose of it was to overstate everything Enron was doing and make it look like it was a more profitable and better entity than it actually was. So what you will see, and again later on in handouts / the videos that accompany this, is we're going to talk about some of the implications about what they did versus what they should have done, what the correction was in the context of the accounting equation, which is the ultimate goal of this first stretch of videos, is to introduce the first main topic, accounting equation. But again, there's a little bit of wind up before we get to that. If you want to look up other nefarious details, I have a fact sheet put together. It says Enron fun facts. Not so fun if you're an investor. Definitely not. And also there is a documentary that's posted as well. So you feel free to watch any part of that. I indicate where you should probably start the documentary, but if you don't want to start there, you could just watch the whole thing, or even like halfway in the middle of it will probably give you a good feel for what happened as far as like all of its the fraud that took place, and also its sketchy business practices. So there's a lot of unsavory things going on when you're talking about Enron. Right now, in terms of financial accounting, we're going to limit our concerns to just entities seeking a profit, which simply means economic inflows exceed outflows. That's what your ultimate goal is there. Now, there are accounting standards for non-for-profit entities and government, but that stuff you'll see in advanced textbooks. So we will not talk about it here. So I'm just going to give you 3 basic types of profit-seeking entities in a couple slides over. All right, there they are. The introduction is a little redundant, but whatever. All right, so we have just the 3. We'll just quickly go over them. Just proprietorships, corporations, and partnerships. So first, what's the deal with proprietorships? Proprietorship is sometimes called a sole proprietorship, meaning there's just one primary owner. This is the simplest, least complicated type of business in the world to create. You can create it online, like on accident, just by selling goods online. Right? You open up an Etsy account, an eBay account, an Amazon account. Guess what? You just became a sole proprietor, even if you didn't know it. So that's why I say the majority of businesses in the world would fall in this category by head count, not by necessarily with their wealth, but just by head count. Now, The second one, corporations definitely cannot be created on accident. That's why I refer to them as artificial business constructs created through what? Legal channels, right? You have to go through some steps. And again, there are different rules for incorporating depending on which state you choose to incorporate. That's why a lot of companies, and an inordinate amount of companies, I might add, incorporate in the state of Delaware because they have the most lax incorporation laws. So that's why you'll see, I mean, again, it's a very small state. If the number of corporations that incorporated in Delaware were actually located specifically in Delaware, other than just obtusely through being, formed there or through maybe a PO box, I don't think there'd be enough room in the state of Delaware for them all to exist simultaneously. It's just, it's just because it's just so popular to incorporate there. It would overrun the state. So once you do create a corporation, now it exists. Again, it's imbued with life, basically. It's treated as living, breathing persons for purposes of taxation, meaning it's taxed separately from anything else. It's taxed separately from the owners and the employees and everything else. So it's taxed as a separate entity. Now, just to contrast that with proprietorships are taxed like basically as you, like you're a primary owner. Well, the tax, it falls to you as the primary owner. The business itself is not actually taxed. That's why you'll fill out something called, in your taxes, you fill out your income tax, you'll fill out something called Schedule C, which is just basically the schedule for people that are proprietorships. And the other thing, the big one, is for litigation purposes, it's separate. So what does that mean? That means that owners, in this case that would mean stockholders, shareholders, neaten that line up, owners, employees, cannot be sued in the context of the corporation they work for, right? They're basically, they're insulated. So if something bad happens in the company and you happen to work for it or own stock into it, people can't come after you. Right now, there are extreme exceptions to these rules that I'm describing. Then it's not all or nothing. Like in the context of committing fraud, for example, for a company, that's one of those where you can jump beyond and say, okay, now this person, because they weren't just simply acting within the context of their employment, they were acting in the context of somebody trying to perpetrate a crime. Actually, and that's what fraud is. It's just a crime. And again, just to give you the rundown of like the 3 layers of criminality there. So you have negligence, gross negligence. Now again, if you're negligent or grossly negligent, they probably can't touch you as an employee, like you're just a really bad employee, right? So they can just go after the company. But as soon as you enter the realm of fraud, now they can come after you personally. So that's why you'll see a lot of times in cases where there was actually fraud, you'll see the people who were perpetrating it will try to act like complete bozos that didn't know what was going on. I had no idea what was going on. You hear a lot of that kind of testimony in any kind of interviews with them or whatever, or if they actually are testifying in front of in a court. They always sound like they're just trying to plead total incompetence. I had no idea what was going on, which basically pushes them in the area of gross negligence, which means they really can't be touched legally or criminally in that case. So that's why they always do that. They're just trying to just mitigate their losses, as it were. So again, for the most part, true, but not 100% of the time. And the big one, though, the big one here, and this is the one that's pretty much steadfast, creditors cannot go after either party for restitution because they have limited liability. Owners have limited liability, employees have limited liability. Again, if we're talking about the fraud, maybe then they could start to go after your personal assets. But again, it's very rare. Like cases like Enron, like we described, would be where you could actually go beyond the scope of the corporation because what they were doing was obviously not in good faith, right? They weren't just merely incompetent, they were trying to perpetrate a crime. But the big one is owners, they're untouchable, right? You own shares of stock, your liability, you can lose your investment and that's it. So creditors can't come after you, right? In the case of Enron, for people who invested and they, their stock was worth, $50,000, and it's worth nothing, and they sued, they can't sue anybody else who happen to be owners in a class that they might see, for example, as like, let's say the chief officers in the context of being an owner. In that case, they could sue them in the context of being an employer, though. Again, that's the exception I'm describing there. But in general, like if we're talking about just creditors of the company, people that the company owes money to, and you're an owner, they pretty much can't touch you, right? It's extreme rare circumstances where they could actually come after your private personal assets. And I'll talk about that later on when we get to chapter 11. When we get to a later video, we'll talk about that. And so we're going to look at corporations as being the focus of the class. So we'll refer to them, but again, it's pretty sketchy as far as what we're going to, how they're referred to. We really don't flesh that out until a later chapter, chapter 11. So it's a while before you're actually going to see exactly what the specifics of corporate accounting look like. And then our last category here is partnerships. Right? It's easy to form a partnership. You can practically form it on accident. Engage in a business with like a friend, or two corporations decide to get together and do something. They just formed a partnership. So you don't have to file any legal documents here, but you should if one of the parties in this business is doing more work. So that's the thing to keep in mind here. So if, let's say it's you and a friend form a partnership, go into business, and you're the one that's doing most of the work, right? You're doing basically, as I suggest here in the narrative, 70% of the load of the work. And let's say you say, well, I should get 70% of the profits of the business then, but your friend says, I disagree, and you end up in court with probably your ex-friend at this point. And the court will immediately ask, do you have any documents, any contracts in the partnership? And of course, you're going to say, well, no, we didn't put anything in writing, which is, again, you're right. Well, then the court's going to say, well, based upon what the default partnership law is in just pretty much every state, is going to say, well, it's equal shares. So the best you can get is 50%. So make sure, again, put something in writing if you're doing more work than the other partners are, because otherwise you're only entitled to your equal share, which would be, half if it's two of you, a third if it's three of you, a fourth if it's four, and so on. So make sure that you put that in writing. All right, so because formality and expense of incorporating has definitely lessened, what you're going to see is that I usually refer to partnerships as kind of a dying breed. Therefore, the specific accounting for these organizations has been relegated to advanced textbooks. So we won't touch upon it anymore in here. I might refer to it in passing, here and there, but otherwise, that's all you're going to hear about, just in the most basic terms. All right, so the next big thing we're going to throw into the mix here is the measurement or cost principle. So this is, again, checking off another one of our boxes from our Generally Accepted Accounting Principles handout / video. And this one actually ticks off two. So we're going to talk about how we're going to, value our, items that we own in the business according to cost principle. And we're also going to throw into this an assumption. So that's 3 now that we've ticked off there. In which case, monetary unit simply means we're going to use the local currency as the unit to delineate all of our transactions in. Everything we're talking about would be delineated in US dollars because we're talking about accounting in the United States. If you're in another country, you delineate in their local currency. So that's just all it's saying. It's just one of those things you have to describe it just to make sure everyone understands exactly what are we doing here. In other words, you can't be in the United States and then decide to delineate everything in terms of Japanese yen or some other currency. We would say no. If you do business in that currency, that's fine, but you must translate it to the local currency, in this case, the US dollar. So here's an example of what I'm getting at here. So we got Mike Speedy Transport 3000 purchased land in 2012 for $500,000, and this was negotiated down from an ask price of $600,000. 2015, somebody offers them $1 million, but they say no, thank you. And in 2019, somebody is going to appraise the land, and they're going to say that it's approximate fair market value, which is abbreviated as FMV. You see it a little bit here and there in the class, because I throw it out into the mix right now, and it's increased to $2 million. All right, so we got 4 numbers on our hands, but we can probably logically, okay, the 600 ask price, who cares, and what somebody offered years ago, who cares? So it really comes down to which of the 2 numbers do you want to value it at, the 500,000 or the 2 million, and there are arguments on both sides. Again, this is in 2019 we're talking about. What are the arguments for and against the 500,000? For, that number is a number we can definitely determine was 100% factual. We paid $500,000, the end. What's the downside? It's old. It's not a recent number. What's the upside of the 2 million? It's a recent value, right? It's more up to date. What's the downside of that one? It's somebody's educated guess, their educated opinion. It's worth $2 million. What if the appraiser was not just one person, but it was 3 people who came up with an average value of 2 million. It's still just the opinion of 3 people. That's going to be your downside because it's just an opinion. So as a consequence of that, which one of these 2 are we going to choose to be as our value here? And with that, I'm going to leave a little cliffhanger. We'll resolve that issue in the next video. So I'll see you there.